Before we get into the episode, a quick reminder that this podcast is for informational and entertainment purposes only, and nothing should be construed as investment or legal advice. If you are enjoying Onramp media content, please like, subscribe, and share, as it goes a long way in helping others find the signal through the noise. Now for a word from Onramp. Onramp is a Bitcoin asset management platform built on multi-institution custody, leveraging our partnership with BitGo and their 10-plus year track record in securing assets, and CoinCover, the premier digital asset risk mitigation company. Onramp's multi-institution custody is a segregated, institutional-grade vault, requiring 2 of 3 institutions at any point in time to sign once a client's unique permissions have been met. At Onramp, we understand that your Bitcoin journey is a multi-generational pursuit, catalyzed by the ideals of perseverance, aspiration, and legacy. That's why we're proud to introduce Onramp Heritage, a suite of private client services dedicated to ensuring your Bitcoin legacy is preserved and passed on, embodying the true essence of wealth that goes beyond mere numbers. If you would like to learn more, please schedule a consultation. As we prepare for the Bitcoin halving and the next wave of global adoption of this nascent and growing asset class, we are halving all annual maintenance fees for clients that secure their wealth before the next Bitcoin epoch.
What you're telling me is that music is about to stop, and we're going to be left holding the biggest bag of odorous excrement ever assembled in the history of capitalism. 1974. 1987, 92, 97, 2000, and whatever we want to call this. It's all just the same thing over and over. We can't help ourselves.
I say when we sell. Hey, I say when we sell.
Jesse, why buy Bitcoin?
Why buy Bitcoin? Well, I've highlighted that one because it's by Andy Edstrom, who's part of the Onramp team. And Andy was ahead of his time. He wrote this in 2018 for his clients and other wealth managers to try to make the case for why Bitcoin belongs in anyone's portfolio. And so, ahead of his time, he doesn't get the props he deserves for that. It's a good book. It actually helped soften the Bitcoin idea for my dad. So important in my family's journey towards accepting Bitcoin as part of our portfolios.
Let's go. Bring it up. It's nice to see a bookshelf behind you. You've got your podcast setup coming together.
Yeah, I got to fill it out a bit. I literally 30 minutes ago, I was like, I should probably put more than 3 books up there. So I unloaded 2 boxes and here we are.
I need some help with that. We got some work to do in this room here.
Well, at least you made your bed. It's
yeah. This is the guest bed, Marty. Come on. I'm not working in my bedroom. I think last time I was on the show, actually, the bed wasn't even in here. So we're making gradual improvements.
It's important. Podcast. It took me years. Maybe we'll look at a clip from a podcast from 2 years ago, considering one of the topics we're going to talk about. And this studio looks completely different.
Yeah. I think we just we're young. We got things we focus on. We're busy. I'm lucky I got this damn painting behind me just because you kept talking about my blank background.
You need to get a curtain, the blinds.
I know. The wife is she wants to come out and do all this stuff, and we'll get it done.
It takes time. I just got a picture behind me for the first time. I've been here for 2 years. I've been sitting on the ground. I've finally got my poster and my picture up behind me. It takes time.
Yeah, the art is coming next. Though there's a couple pieces of Bitcoin art, prints that I want to get, but I can't justify pulling the trigger on a nice print now versus holding for another year and then buying it. So
if you go to Matex, you can send him a Bitcoin and he'll send you the JPEG file of it.
Yeah, it seems like a good way to go. Good for him. That was a pretty epic move, responding to David Bailey with that.
I have a print of Delaware or Washington crossing the Delaware that I need to get up behind me, and it's fitting because I look at the Delaware River here in the Bitcoin capital of the world of Philadelphia every day. So.
All right, we got some work to do, Jackson. Okay,
Jackson, on what basis is Philadelphia the Bitcoin capital of the world? And is that current or future?
It's current. I think it's all marketing. What makes Austin or Nashville the Bitcoin capital of the world? we had 125 people show up to Bitcoin John on Monday to come, meet other people in the space. We had people coming in from DC, Baltimore, the middle of the state. Matt Kita and Andrew Hans, who organized the event, did a great job. They brought Lynn Alden in. So I won't get too far ahead of myself. I'm joking when I say it's the Bitcoin capital of the world, but it's nice to see that people are starting to show up and there's more of a presence here in this great city.
It is a great city. Speaking of Andrew, I got dinner with Andrew last night. Road Warrior in the space. Started his week in Philly. I was in Austin last night. We had a nice dinner. That man can talk about Bitcoin for hours.
Yeah, we got to get him on. I think whenever he's ready to come on. I know that they're working on some stuff that was a little behind the scenes, but whenever he's ready to talk about it and just his travels, we were referencing how much he's on the road. I'm sure he could educate us on a lot of things that are happening across the world.
Yeah, a road warrior to aspire to. Let's start with gold. What is going on with gold? It's pumping right now. I think I've been doing a lot of reading on this week, trying to prepare for this episode. And I think the big story, really going back to 2020, is the divergence between treasuries and gold. And you have two assets that have historically been risk-off assets that people have piled into. Treasuries being deemed risk-free assets, essentially risk-free assets by many allocators and the government itself. And it seems like that correlation, historic correlation, broke and is really breaking now. What is gold telling us? Is gold having its day?
Yeah, well, for people who aren't aware, and I wasn't fully aware, it looks like gold finally broke out of its $2,000 per ounce level that it, I guess, has been stuck at since 2011. It first bumped up against that and then had, a bit of a classic cup and handle since then, bumping back up against $2,000 per ounce in 2020 and then getting stuck there for the last 3 years and change. And then now is in the last 2 months up to $2,300 per ounce, which I guess in gold is a big move.
Yeah, without being, I think the notion from macro finance experts is that gold has been held underwater for so long that whenever it makes moves like this, it means a lot of things are happening across the world and macro in general.
Well, I don't even think it's a temporary event that's driving these flows. It looks like something structurally is different in the market, where people are choosing gold over treasuries, which is not good for treasuries.
I think Marty got it with how he led this off. And Logan, if you want to pull that chart back up, that tells the whole story right here. So for people who can't see on the screen, there's two lines. There's the price of gold for the last, it looks like 6 years or so, where it's kind of trending up. And the last half of the chart is it really kind of accelerating. The other line is treasury prices, which track gold for the first half of that 6 year time frame, but then the last 3 years treasuries has gone down into the right while gold has gone up into the right. And Marty, I think you're right. I think this goes back to that geopolitical shift, the end of Bretton Woods 2 and the start of Bretton Woods 3, as Zoltan Pozar put it, right at the start of the Russia-Ukraine war, when the U.S. seized Russia's foreign exchange reserves. And from, as Zoltan put it, it was the end of inside money and the beginning of a shift towards outside money, meaning money that is outside of the financial system, outside of the control of international powers. And that means commodity money, and that means gold, historically, first and foremost. It also means Bitcoin, and Zoltan noted that at the end of his letter, saying that if this is true, Bitcoin will probably be the biggest beneficiary of all, even though he's not a Bitcoin bull himself, or at least that's how he categorizes himself. So, fast forward a few years, that seems to be what's playing out of why hold treasuries if treasuries can be seized. Like if you're maybe not on the best terms with the U.S., maybe you're China, are you really going to hold U.S. treasuries as part of your reserves? Or do you, because of the example of Russia having their U.S. treasuries seized, confiscated, maybe you don't want to hold that anymore. Maybe you want to shift to different store of value assets. And historically, that's been gold. And of course, that the narrative also plays in with what's going on with the sheer scale of the U.S. National debt and the math that's hard and fast that we're going to have to print more dollars to deficit spend to service our debt, accelerating the debt, increasing inflation. And in that environment, U.S. treasuries are not what you want to hold, because if you're holding U.S. treasuries, you're holding a small nominal guaranteed yield in a currency that's being debased, and you don't want that. So I think the shift makes sense when you view it from the macroeconomic perspective. It suddenly makes a lot less sense to hold U.S. treasuries, and if you don't want to hold U.S. treasuries, maybe it's time to shift back to the tried and true store of value asset like gold, and make that a bigger part of what you're holding. And that would explain the divergence of U.S. treasuries selling off and gold bidding up.
Doesn't it all seem so antiquated? Thinking about gold, because you break down gold and you're like, okay, all right, now they got to store it somewhere. Now you got to have armed guards. Now you need armies. And you start thinking about all this stuff, and not to tie it back, but multi-jurisdictional, all these ideas and notions. It's like the whole thing of the futures here, we're just not, and it's not evenly distributed, is literally like, we could also call this podcast this, because it's just like these, and we know the end state, or like directionally. It's just how long does it take to get there?
Well,
100%.
Look, and pull up that other chart. It's like, we do know the end state. Are we in the? That's what I think. Gold in treasuries moving the way they are, screaming at the markets right now. Something is broken. I don't think most people perceive the gravity of the structural break that is happening in financial markets right now. Like, this chart is astonishing. It's literally hyperbolic. So what we're looking at, if you're not watching on Spotify or YouTube, is U.S. interest payment scenarios on the debt that we've accrued federally. And it's a hockey stick chart. And there's two scenarios. We've really three scenarios. What's already materialized in terms of the growth of the interest expense on the debt. And then there's two lines, projection assuming rates stay stable, which it seems like they are. Jerome Powell came out earlier this week and said that they really don't want to lower rates until they're certain that CPI is under 2%, which doesn't seem like it's going to happen anytime soon. And then even if there's another line here, yellow line, assuming a 150 bips Fed cut this year, and it really doesn't make a material difference in the growth of this chart. So we are in the debt spiral that many people have been talking about within Bitcoin for years now. We've been called crazy for saying that this is going to materialize, and it's materializing right in front of our eyes. And you have pricing signals throughout the market essentially confirming that. People are dumping treasuries, going into gold, going into Bitcoin, and yet I don't think the broader public or even the broader mainstream financial industry has really internalized this fact right now. Like, we are in the middle of the debt spiral, and I don't know if it's head in the sand, cognitive dissonance, people don't want to acknowledge it, or just pure oversight of what's happening in front of your eyes.
Yeah, it's all of the above, and math is hard. I think that's a big part of it. That tweet was from Lynn Alden, and she and Luke Groman were the two people who were seen around the corner 18 months ago, and were dead right about. At the time, they were pointing out how it's really going to be head spinning for people when high Fed interest rates are actually stimulative to GDP and the money supply, which is completely counter to what you'd expect. And the point they were making is that because of how high the national debt is once interest rates are increase and the debt rolls over those increased rates. Now the interest expense on the debt necessitates more deficit spending and necessitates more debt issuance. And that debt issuance goes straight into the economy, straight into the money supply, and actually stimulates the problem, makes it worse, rather than helping to bring down inflation from trying to reduce consumer spending. It kind of has the opposite effect of like the tail wagging the dog, because consumer spending is decreased, but government spending is increased because they have to pay this interest expense, and they're sure not going to cut other spending types. So it all amounts to more spending. They were dead right about that about 18 months ago. And that was a hard mathematics concept to conceptualize, to hold in your brain and project forward and see how that all teases out. And most people, are just don't think that way, I guess.
Somebody needs to overlay the Bitcoin price with that chart, because it just reminds you of the Weimar chart with gold and the whatever the currency. What is it? The
Weimar
mark.
mark. Yeah,
The mark.
Yeah, Weimar mark, but it's very similar. Go ahead, Jackson.
Yeah, I was just going to say that we all feel at this point that we're in a debt spiral. We're at the early stages of it, and what's coming is a sovereign debt crisis. And I have to think back to my grandfather, who silent generation, young in the Great Depression, fought in World War II. And how do those macro events impact human psychology and investor behavior? And the reason why I bring this up is because my grandfather and his generation invested primarily in, or saved primarily with, government bonds, CDs, some precious metals as well, even though that was illegal at the time. And then the rule of thumb changes, right? Like how do you save? If you can't save in dollars or money, you have a proxy for money, and that has become, like I just mentioned, CDs, bonds, etc. for one generation. Then it became the baby boomers and Gen X that primarily used equities, real estate as their form of savings. And I think now we're really just still in the early stages of Bitcoin. Well, this is different because it is a form of money, but it becoming the de facto premier savings technology. And it's being adopted at a much higher rate for millennials and Gen Z than it is for Gen X, baby boomers, etc. So I think that's all to say that, the Great Depression really was formative in how people chose to save their money. One thing I meant to mention that I overlooked was that my dad, about 20 or 30 years ago, had recommended to my grandfather, who again was, living through the Great Depression, you should invest some of your money into equities. Here's why. This is a good way for you to kind of protect your purchasing power. And he was so risk averse because of the stock market crash during the Great Depression that I don't know if he ever invested in equities at all. So I bring this up because I think we're really, at the start of a big macro event for a sovereign debt crisis in the US, but also in other nations. And this will be extremely formative in how people continue or proceed in saving their money and protecting their wealth.
How do we think this impacts housing? I don't know if you guys saw the blog, or there was a Reddit post that went viral about an Austin person that bought real estate. It's underwater $200,000, and so it's interest payments or mortgage $5,200, just completely kind of screwed. And there's two notions, right? We can lower interest rates, prices got to get inflated across the board, and we continue. But it feels a little bit like maybe that's not the direction this goes. And if that is the case, there's a lot of people underwater in their real estate.
Yeah, my view on this, I once I fully unpack all my books, I'd pull up When Money Dies, which is a bit of a deeper cut in the Bitcoin space in terms of books, but it lays out all these vignettes about what happened, what did it look like, what were the dynamics going on in Weimar Germany as the Weimar mark hyperinflated, and some of the takeaways from that is that the people who did well were those who stored their value in hard assets. Gold did the best. So people who stored their value in a few ounces of gold early on were then able to buy a bunch of assets once the hyperinflation had devalued everything dramatically. And part of that process was during the middle stages of hyperinflation, property investors did well, and stock market speculators did well because the nominal value of those assets went up, and so they thought they were doing great. In the long run, they didn't, but for a while there, for the deep into hyperinflation, anybody holding assets thought they were getting rich. And I think that could be what happens with real estate. I mean, it's sort of already playing out. Canada is sort of a great example of what, the path we could go on of real estate valuations just getting sillier and sillier in the nominal US dollar terms as the dollar is debased at a faster and faster rate, and people are desperate to put their value into a savings vehicle. And we pretty deeply have adopted the psychology of like real estate is a safe place to store value. It's a good savings vehicle. And so I think that, as the dollar debases at a faster clip, that like desperation and that resorting to real estate as a store of value will probably be the track that people follow, rather than turning to gold or Bitcoin, which is really going to be the asset that I think is the way for people to survive and thrive through the debasement of the dollar.
I think a little of that it's breaking now simply because of the down payment for most people is out of people's reach. But the last pod we did with Thayer and Lepard was really like helpful. Myself being like, I think following closer to Marty, and I think Jesse, you as well, of like, I think we end up in a lot smoother transition than everybody believes or like our peer group goes through. I think like the whole way this works out, because of the incentive models and the way that we can think about the distribution and however you want to decide to hold the asset, is a lot different than historicals in the sense of it's going to be I think it's going to play out a lot more seamless. And I know a lot, we obviously have a lot of friends and peers building in the space to help with, accepting Bitcoin, storing it, different financial products that are just opening up to more and more consumers that once they get their taste from, the BlackRock ETF or whatever and realize what's happening, versus going and putting that 100K in the house, they can, store in a better form of money to increase purchasing power, so then they can actually like transition in this way. And as people start to accept that because they recognize that, I think it just like aligns and smooths this all out versus what's traditionally known in the circles we kind of follow, or people that listen think this is going to be a lot bumpier. I'm starting to be a little more optimistic on how this all like churns out over the next decade.
Even if it isn't something catastrophic or a violent transition, right, in the sense of just like chaos, I think there still is like a big sense of urgency to adopting Bitcoin because really fundamentally there's so much capital that's tied up in fixed income, because people have been operating in a world where the US Treasury was sold to them as the safe haven asset, right? So I agree with you, Michael. I don't necessarily anticipate like Mad Max, right? I think it'll be pretty peaceful. However, we transition into like a next monetary order, but that's all to say that a lot of people are going to be really financially crippled if they are over allocated to fixed income, in particular, what was perceived to be the safe haven asset, US Treasuries. And that's concerning to me because I think there's a lot of retirees who thought that they were like, in a good position financially. Maybe they had enough to retire and then also pass them down to their children. But financial repression is an inevitability. So inflation will have to be higher than interest rates, which means that people are going to lose money. Maybe it doesn't happen like catastrophically all at once, but over the next 5 or 10 years, people who are over allocated to fixed income, I think, are really going to be in for some financial hurt. And that's a sad thing.
It's bad. It's bad. Look at that TLT chart. It's down 22% over the last 5 years. And Jackson, as you were just mentioning, I mean, the complacency of the asset management space, particularly for retirement accounts, has these target date funds that literally force your allocation from a 60-40 stock bond portfolio to 80-20 towards when you're approaching retirement. You have the most people ever in American history approaching that retirement age. More people are retiring every day in the United States than ever have before. And they're retiring with a portfolio that's essentially 20% underwater. Maybe their stocks are, let's say, 15% underwater if their stocks are making up for the underperformance in these treasuries. And obviously there's probably a select few who took more agency over their portfolio allocations and maybe got into some alts and some hard money. But I think it's safe to say that an overwhelming majority of the people who depended on these complacent asset managers to just construct their portfolios for them are running into a buzzsaw right as they retire.
That's why I think I was gonna say that's why I think it's important, like, to share this stuff with the people you care about. The people that you don't necessarily care about, like, or don't want to listen, like, they'll figure it out, whatever. But the people you generally care about, you almost have to be relentless and share stuff like this. And because the reality is, like, I found out the other day that somebody close on my wife's side finally built a sizable Bitcoin position, and I thought, like, oh, she got it. She wasn't that. She was she's a spike coiner, basically. She's like, I had to do it just in case, you were right. I couldn't have heard all this for years at the dinner table. And then, like, to your point, they retired and now they don't have any wealth because it messed up. So she just did it out of, like, hedging, which is fine. Like, do it however you get there. But I do think
stack is a stack nonetheless. Okay.
It's a stack nonetheless. And so, yeah, I think it's just important to, like, just this whole thing that we're doing, like, it actually matters to share and have the conversations with your family and forward the newsletters and all those things, because to Jackson's point, like, there's going to be a lot of repression with people that thought they had a lot of wealth that is just getting depleted year over year.
Well, going back to Jesse's earlier comments on when money dies, that's the most insidious part about all of this, is because the dynamics of the system are such that two routes: overt default or soft default. And they're going to pick the latter. Yep. And people are going to think that they're getting rich. Their paper...
They're going to gaslight you.
It's already begun in that sense. People are like, wow, the stock market's doing great. I mean...
Inflation's 2%.
Yeah. I remember in finance class 15 years ago, my professor being like, if you can find me a 7% return, equity, I'm interested. Like, pitch them to me. Like, she was soliciting, like, ideas for investing, because 7% was like a dream 15 years ago. And now we've just been consistently returning 10, 11% for the last decade on average, because, we're debasing. And so it's not real returns.
Yeah, I think to go into the complacency piece, Marty, in the managed wealth space, I think it does come back to just kind of generational differences, because I think the average age for as an advisor is maybe 55, or maybe somewhere even later in 50s. And I was running some of the numbers for an article I had written a couple of months back at this point, and just I was trying to find the data, but just the number of, or based on volume in terms of crypto buyers, right? So all encompassing Bitcoin and then other coins. It was about like 94% of all volume of crypto purchases are Gen Z and millennials. So I do think that, unfortunately, just there's a complacency because people, generally speaking, are not willing to challenge their thought process or even ask the simple question of what is money, and what is this all for? Why am I doing this? What is financial planning, right? Like, there's a lack of first principles thinking, and it's really just kind of a herd mentality when it comes to just looking back over the past 40 years from 1980 to 2020 and just assuming that whatever worked in the past will work going forward and feeling okay with that, right? Like complacent, as you mentioned, just because most of your peers are doing that as well. I think this all kind of ties into the $80 trillion of wealth that's held by baby boomers. And as that continues to trickle down into younger hands, that is just kind of like a natural flow into Bitcoin and probably, unfortunately, crypto as well. But I do think as advisors get younger and then also their clients, we're going to see quite an increase in allocations to Bitcoin and ultimately that becoming a form of money.
Yeah, I have a spicy take here. I think that the Bitcoin is a generational reckoning. It's a karmic rebalancing of the excesses that the baby boomer generation received, whether or not they admit it. They had an incredible set of tailwinds for their wealth building years. And a lot of baby boomers, whenever I bring this up, some of them push back and say, well, it didn't benefit me. Well, it could have. You didn't play the game the way that other baby boomers did, and they did very well. What it amounted to is the baby boomers have a disproportionate amount of wealth in America and the world. And it's the really interesting chart from the New York Times that they should update, but it tracks the percent of total wealth held by different generations at that age, at that point in time when they were a certain age. So like, you know, the baby boomers, I don't know, whatever the average age is, 60 or 65. Gen X, 45, millennials, 35, whatever it is. And what percentage of the wealth have they accumulated, tracking by age 30, 31, 32. And the baby boomers have a, high up and to the right dominant share of wealth. The Gen X is, about half the trajectory, meaning they're gaining wealth relative to the total amount of wealth that exists at half the rate that the baby boomers were. And millennials are about half of Gen X. So, which means to say that we're gaining wealth at a quarter the rate that the baby boomers were when they, as they moved through life. So we, as millennials, as a generation, we at this point in time have like a quarter the wealth that the boomers did when they were our age. And we're on the trajectory for that disparity to continue. So Bitcoin becomes this generational reckoning, a rebalancing, where millennials have an opportunity to catch up to the baby boomers. And, the flip side of that is, sadly, the baby boomers are not in a position to embrace the new. They're in a position to hold on to the old because the old did very well for them. So they're disinclined to try something new, to change it up when they've had such success building wealth with the 60-40 portfolio. So they're going to hold on net. They're going to hold on to what worked before, and they're going to see their wealth slip away in their retirement as the millennials gain wealth.
The ultimate rugging.
It's the ultimate rugging. And for that matter, if you're a baby boomer, the real play, the way to beat the millennials at the game that they're going to win is to jump the gun and adopt Bitcoin before the millennials do. So you can, as a baby boomer, you're not, it's not guaranteed that you're going to underperform. The question is whether or not you will embrace Bitcoin before the millennials on average do. And that is in your hands, and the opportunity is there in front of you to beat the millennials again. But if you take no action, the millennials and the younger generations behind us will eat your wealth as Bitcoin accumulates, it monetizes, and everything else underperforms.
I think it ends up 50-50. It ends up 50-50, like more millennials than boomers end up early adopters, but boomers with more capital. So you end up with a similar allocation. And then the rest, the laggards, all just have to adopt it because it's just the thing that has to be used. Because I think it's more of a lens thing of the world than anything. Like the meta version. Yeah. It
kind of becomes a litmus test for the boomers of like, can you preserve your wealth? All right, great. You made your wealth with a bunch of tailwinds, but are you savvy enough to realize that the winds have changed tack, and preserve your wealth by shifting your strategy? And that's going to separate the wheat from the chaff in the boomer generation, the real savvy investors, the smart wealth retainers versus those who got lucky. And we'll see what happens.
Logan, can you show that stacking screenshot? Because I think that's like the positive from a Gen Z or millennial or anybody that's looking just to start today. The chart showing buying $10 of Bitcoin every day from April 1st, 2019 to 2024, and 18,000's turned into 70,000, a 285% increase. And this is like ultimately what we're talking about, whether somebody has 0 Bitcoin today and starting, this idea of preserving your wealth and being able to like save for the future is the whole idea, whether you have 0 or you're sitting on, 10 million plus as a boomer.
Yeah. $10 a day, 5 years, you wake up and
you can start a business.
Each $10 that you spent is now worth $28.50. It's pretty crazy.
Yeah, it's crazy because you think about like the freedom. If you're working day to day and you're living paycheck to paycheck, you make enough, and now you're sitting on close to $100,000 in 12 months. What is that? And now you can actually go do something. Like the level of productivity unlocked from what we know this can do is just like you just have to start somewhere.
Yeah. I've been reading a lot this week about the history of eras and where we find ourselves. Michael, did you wind up reading the rest of that piece?
I haven't. Do you want to summarize it, or should we like read it? And is that book club homework for next week? And
I think it's book club homework. It's a long 45-minute read, but I think really the most profound piece I've read since The Sovereign Individual, again, putting the Sovereign Individual was written in 96 and was very prescient and prophetic for what has played out over the last 30 years. But this is a piece that was written about like, all right, here's where we are now. Not really hearkening back to The Sovereign Individual specifically, but a very similar piece that tries to define eras throughout history. Sovereign Individual broke it up into 500-year super cycles defined by technological innovations that really spurred on different eras, whether that's the Protestant era with the printing press, the Industrial Revolution with the steam engine, a digital age with the microprocessor. This was similar but a bit different, where it really defines eras throughout history, very binary. We've had centralizing eras and decentralizing eras, and it's pretty clear that we're moving into a decentralizing era. And it was actually, I forget what the piece was called. I'll put up a link that Logan can flash up on the screen, but it was very illuminating and clarifying, and actually a bit not cathartic, but it gave me peace about the current state of the world, because a lot of people get pissed off about politics, the state of the American government, and red team versus blue team. But this piece, particularly the last third, did a really good job of just saying, hey, this is just the product of the end of a centralizing era that we're transitioning out of and into a decentralizing era, and the bureaucracy that has been built up in the central government is not something that you're going to change. No politician's going to change it. No amount of voting is going to change it. The bureaucracy has been set up, and it really runs the show, not the politicians that you vote in or out of that bureaucracy. The point being is that the level of centralization in that bureaucracy is getting to a point where it's about to collapse in it of itself, which, as we've discussed throughout the show, the debt levels, the interest expense on the debt, the state of treasury performance, I think those are the clear signals that that's happening. And the big question is what's the transition into the era of decentralization that we have before us look like? And it's a bit unnerving. In the piece, they say, too, probably not going to be Mad Max, but it's going to look way different. And we're beginning to see examples of what it may look like on the other side materialize, with states asserting their autonomy against the central government, like here in Texas, Florida, the states that have legalized marijuana, despite the fact that marijuana is still a Schedule I drug, and it'll get even more local. So, like, to your point about, like, how does this play out? And I do have a point with this long rant. It's that these problems that we're talking about are going to persist and get worse. But what you're going to find, I believe, and what this piece did a very convincing job of convincing me of, is that things are going to get very local. you're going to fall back to like the Fed and the Treasury are not going to solve this problem. And this is something anybody listening to this should begin to internalize and think through moving forward, is like the problems are going to be solved locally. Your pensions are going to get blown out. Your house value is going to be decimated. Bitcoin's probably going to go up a lot. And the other side of this playing out of the end of the centralizing era that we find ourselves in will be very decentralized and local. Sorry for that long rant.
So should we read it or not? I was about to say I'm excited about it because you kind of got me excited about maybe a format like once a month we find a piece and we do like a popcorn where we each switch, and then like because Leon Wonkum's coming on next week, and the idea was I was going to say we can share this piece and we all read it and then come back for like 15 minutes next week and discuss, because I think what you interpreted is probably going to be different for Jesse and probably for myself on like what it's saying. It could be make for an interesting discussion. There's probably going to be directional themes that we all agree on, but I think it could be fascinating. The chart I think about when I opened it and then I fell asleep because I opened it like at midnight was that right there. Or yeah, I think scrolled down. There was like where it showed what people perceive as there is like the top part is what people perceive as what will look like if we were to like separate, and then you scroll down and then it's like what it will most likely look like.
Yeah, and this, for any history buffs out there, it's a really good piece to put a lot of historical things in context. And basically the long thesis that is put forth in this article is that decentralized errors happen when very powerful technology has reached the point of commoditization and is easily accessible to everybody. And this is why it harkens back to the sovereign individual. It's when any individual can have extremely high leverage against a powerful force like the government with accessible technology. And it's becoming clear that with Bitcoin, private public key cryptography, the internet, the communications technology that exists today, and then even upgrades in military tech, whether it be just pickup trucks or cheap drones, whatever it may be. I think we are at that point where very small individuals can be very, have a lot of leverage with very few resources and capital.
Yeah, I guess that's in tension with the sort of sci-fi trope of like technology is most useful to governments trying to get and maintain greater and greater control over a population. So we'll see how that plays out. I mean, the idea of like neo-feudalism is pretty interesting, and we'll see if it's possible. It does kind of bring back that like philosophical like question of like are we as people, as animals, really intended to be ruled by a worthy ruler who in a meritocratic way, the way that in theory monarchy was, or at least originated, of like a ruler leading from the front, sort of William Wallace type of leadership. And it's kind of impossible to imagine that returning in our world where there's so much fakeness from the political class. And I think if we get to that extent of like Balkanization that map showed of the U.S. into like fiefdoms, that would mean a pretty Mad Max sort of political landscape, I would think. So I hope there's some happy medium.
Yeah, we had this discussion a while ago in Austin. This was like early days when COVID was, people were coming down, and about what Jesse's referring to. And it's like everybody wants to theorize about a king ruling them until they're under rule by a king. And it's like that democracy probably is the best that we have. We just messed up the money. And so we have a good form of money and democracy. We're probably in a good spot moving forward. But I do think to Mark's point, it'll be good to like read through that and see like how this actually, our feedback, because what you reference as cathartic, maybe you meant cathartic or like comforting, in that like a lot of historical texts are helpful because they just anchor what's happening, that it's happened before. And so you can actually feel comfortable and like, there's nothing new under the sun. It's just a different lens or like different way it's happening.
Yeah. And it's was it's good context to zoom out. Be like, don't get triggered by the day-to-day monotony of the political system and the moves by this current administration, the next administration, previous administration. It's all, you got to zoom out and understand that you're on a wave that you likely can't control to any large degree, and don't get triggered. Focus on what you can control. Stacking Bitcoin, holding your own keys, building out tools that make it easier for people to do so.
Thanks for tuning in. If you're interested in exploring any of these topics further or want to learn more about how we can help you secure a new or existing Bitcoin allocation, get in touch with our team at onrampbitcoin.com. We look forward to supporting you on your Bitcoin journey.
Well, on that note, we don't have to get too heady on the esoteric philosophical musings of a paper I read earlier this week, but something that the audience should be aware of, very interesting development for Bitcoin, very sad development for the world. Massive earthquake in Taiwan earlier this week, 7.5 magnitude earthquake, I believe, caused a lot of damage throughout Taiwan. Why does that matter for us? Well, TSMC is one of the largest semiconductors manufacturers in the world, and they produce chips for Bitmain, for the ASICs, in Taiwan. And so I think it is yet to be determined the extent of the damage that was done to the TSMC facilities in Taiwan from the earthquakes. But I think regardless if there was a lot of damage or no damage at all, it is something that we should highlight, is that this is a centralizing force in Bitcoin, is this chip production, but it also provides an example of how something like an earthquake, which isn't intuitive to individuals thinking about Bitcoin, can be a black swan event for the Bitcoin ecosystem. So again, it's yet to be determined what the overall effect of the earthquake was on TSMC's facilities. Still trying to figure that out, but potentially, if the facilities are damaged to a point where they cannot operate, that could have significant effects on the supply chain of Bitcoin mining machines, predominantly Bitmain machines. And so you can have something like a weather event, like an earthquake, not weather, a geological event, a seismic event, like an earthquake, affect Bitcoin hash rate.
What does that mean? If you reference you shared the clip from 2 years ago, the guy from Brains that was describing how I think that's interesting in that just the movement, subtle movements, disrupt the manufacturing to the point where the chips are non-usable. So I think that goes without question that it happened. I mean, that it wasn't subtle movement; it was an earthquake. So there's already a bunch of chips that were in production that are not going to be able to be used.
Yeah, any chips that were literally in the process of being laser sketched and layered as the earthquake are going on probably need to be thrown out. And it's yet to be determined if Bitmain and other producers had chips that were actually being manufactured on the floor as the earthquake is happening. But Jan Kapich from Brains, co-founder of Brains, and an extremely smart guy in the mining space. We've got a clip here that we'll play from 2 years ago in this studio. I was referencing it earlier. The studio looks a lot different than it did back then.
It takes time. It's growing. The silicon is growing, the different layers, and you just can't speed it up. The process.
Yeah.
So it's very similar. So you have an estimate where when the chip is going to be ready. But if there is, for example, a seismic activity, so like a micro earthquakes in Asia, where some of the foundries are, this affects the process because we're at such small dimensions where like any seismic activity is it an English word, seismic?
Seismic, yeah.
Seismic, yeah. Sorry. So when the Earth moves, it influences the manufacturing process, and sometimes it screws up the chip, the wafers.
Really?
So they have to redo it,
Really?
or they have to stop the manufacturing. So it's sort of like weather that has impact on growing crops. Here, it's not weather, but like geological geological processes have effect on manufacturing sometimes. I'm not saying always, but that's what I heard. Like they have to account for this.
That's insane. I didn't know that.
And then, Marty, what was the context for him bringing that up?
The context was he thought there should be futures hedging products for the chips, the ASICs, specifically the wafers, not necessarily the full final form factor of a Bitcoin miner, but literally the ASICs coming off the foundry floor.
Interesting.
To account
for manufacturers to hedge. Yeah, to hedge.
For manufacturer, or for ASIC, for Bitmain and MicroBT, companies like that to hedge their risk. Because you can imagine, Bitmain has sold a lot of S21 futures orders that are due to be delivered later this summer and fall. And if there's a scenario in which those wafers for those particular ASICs that they've already sold, the futures orders that they've sold, were being produced as that earthquake was happening, they have to scrap that whole line and start over, which delays the delivery of those machines, I would have to imagine, and probably adds more capital on Bitmain's side, unless maybe they have insurance to account for something like this. But you could imagine there will be more capital pushed into this, which could affect the price of ASICs. And then if the foundry was critically hindered from operating as it has been up to this point, and you have something like a large reconstruction that is necessary to get it back up and running in the first place, that could have profound lasting effects on the supply chain of ASICs, which could artificially hinder hash rate growth over the next 18 months, 36 months, whatever it may be.
Isn't it that bullish Bitcoin though, right? Like just a beautiful
bullish hash price. I mean, if you have miners plugged in right now, you're selfishly like, this is awesome.
Well, I mean, like the long-term viability of the network and decentralized, like the idea is in a free market, if that happens, you go and set up shop somewhere else. So you're not sitting where earthquakes happen. And so you have a more resilient manufacturing, and it gets accelerated or pulled forward because of this.
Yeah. It's funny how, with Bitcoin, you have to contend with things like the Ring of Fire and and adopt your operations accordingly. So like on both sides, because I'm still bullish on volcano energy. I think we'll see more and more geothermal mining over time because it's there for the taking, and people just have to invest that capex. But at the same time, you probably don't want your chip manufacturers on the Ring of Fire. So it's a funny geological element that you have to contend with as in Bitcoin mining as an industry. Marty, I also thought it was funny how we could see how your memory of seismic activity and weather got linked because of that conversation.
They're different. And it's obviously prayers out to everybody in Taiwan and the affected areas, Japan, with the tsunami and all that terrible shit to see. But it is like, it was a little fun. I was like texting people that night after the earthquake. I was like, is it fucked up? Like my first thought is, what's going on with TSMC? Are these chips going to be okay?
You're a true businessman there.
Yeah. But yeah, it's something to be aware of if you're out there learning about Bitcoin. Many think of it as this ephemeral digital thing that you can't touch, but there are aspects of the network that are very physical and highly dependent on hyper industrialized processes to actually make it work in the real world.
Yeah. But it's also a great little microcosm example of Bitcoin's anti-fragility and the incentive model that allows for anti-fragility, because if it's unprofitable or if it's a business risk to be running a foundry on the Ring of Fire, then over time you would expect competition to go elsewhere to account for that. And then that decentralizes chip creation. It also gives that new foundry a competitive advantage over people who are having to deal with tossed out screw up chips because of earthquakes, and in right there you've got a little example of how the profit incentive of Bitcoin mining causes adaptation, which overcomes problems, and that is anti-fragility, and it's baked into how Bitcoin runs because everyone's trying to make money.
Yeah, and to add more context to this, TSMC produces the ASIC wafers, the chips for Bitmain. The biggest competitor to Bitmain is MicroBT, which leverages Samsung foundries in South Korea. So that'll be another interesting thing to see, because this affects most people were focused on TSMC over the last couple of days because of NVIDIA. They've got large purchase orders in for their GPUs that they want to push out for AI. Only Bitcoiners are like, what's going on with Bitmain chips? So that's the other interesting factor beyond this. If TSMC is materially hindered, that is yet to be determined. They could have very robust foundries that are prepared for these types of earthquakes and will be able to operate business as usual moving forward, just have to scrap the stuff that was being made at that particular point in time. But playing down the hypothetical that it's not the case, South Korea, Samsung, that's where MicroBT makes their chips. And I think that would be the next thought in people's minds. It's like, oh, is this an opportunity for MicroBT to take market share? But then you have to think, does TSMC foundries going down create a crazy spike in demand for Samsung's foundries that extend well beyond Bitcoin mining? Could that actually hurt MicroBT's production of their ASICs as well, because the AI companies are able to pay more for that foundry space? You're listening to the ramblings of somebody who's heavily involved in the mining industry and has to think about these things.
I think to Jesse's point, it's like the market dynamics are amazing in the sense of if the price of chips or ASICs increase, then it hits a certain equilibrium point where people go out and start to produce or get in capital investment. So it naturally just rises, specifically also with the Bitcoin price or AI proliferating. Marty, I'm curious, something kind of like, I don't know how big it was, but Coinbase and Lightspark and Lightning, and just knowing what 80 million users or whatever Coinbase has, what's your take, or have you thought about like what the reason why they would be investing or partnering with them to open it up and like where it fits in their model? Because wasn't it like 2 weeks ago or 3 weeks ago, Coinbase came out with their like commerce or merchant payment, where it was like a closed loop system where you could only pay if you were like, I think, had an account with Coinbase. But this seems like kind of contrary, or like the opposite of that, because that would make, I guess it maybe a lot of things they do don't make sense. So maybe they would only do it within a Coinbase Lightning wallet. But do you have any thoughts there?
First thought, Coinbase is completely spread thin and does not know how to actually build Bitcoin products. And so the fact that they're outsourcing this to Lightspark is laughable. Not surprising, though. Lightspark, another A16Z portfolio company, and that's what A16Z likes to do, is to get their portfolio companies to work together. Yeah, I mean, it's good to see. They should implement Lightning. They should have done it years ago. Many exchanges, Kraken, Bitstamp, Bitfinex, River, Cash App, keep going down the line, have implemented Lightning well before Coinbase, which is supposed to be the largest, most reputable, most professional exchange in the world, has done so. I mean, good. It's a good deal for Lightspark. Big splash for them.
But any thoughts on like implementation, like why they would, like what they would the use case would be? I think is like what would be the purpose?
I mean,
like, is it for withdrawals? Is it withdrawals like similar to the Bitcoin native companies you're referencing, or is it for like? And you don't have, if you don't have an answer, it's okay. I personally don't know.
Withdrawals and enabling payments. So you mentioned the commerce thing. I think they shut down the ability for individuals to pay Coinbase commerce invoices with Bitcoin that wasn't already held in a Coinbase account, because they were worried about on-chain fees, and they didn't want people sending small UTXOs that would be expensive to consolidate down the line. But I think that was a lot of hand-waving by Coinbase and a abdication of their ability to actually implement Bitcoin upgrades like SegWit and Taproot, which would make that a lot cheaper and catch them up to speed with everybody else. I think the market, they've been sort of bullied into this over the years. Brian Armstrong tweeted, I think, a year and a half ago, that, okay, you've been asking enough. We'll implement Lightning. The fact that it took them this long to come out with a big announcement, the announcement being we're partnering with somebody who's going to do it for us, is hilarious. The fact that they can't do it themselves. They're more focused on Ethereum, their L2 base, whatever they're calling it, and getting people to trade degenerate shitcoins, because that's where they get most of their revenue.
Coinbase will be a funny case study when we look back at all of this, because like what you just described, that's like a micro example. I think the macro one is that they hold no Bitcoin or very little Bitcoin over the course of 10 years or whatever. It's like how far they missed the
12
mark.
years. They've been since 2012.
How far they missed the mark on this whole thing.
Yeah. Colossal screw up. I mean, if they had played their cards right, they would be the single largest holder of Bitcoin. Instead, they are the single largest custodian of others' Bitcoin, but they don't own any, or at least very little. It's really a shame.
I mean, their early user base, individuals probably have more Bitcoin just from Coinbase's referral program than Coinbase has as a company on their balance sheet. Because at the very beginning, the Coinbase referral program was like, if you get somebody to sign up via your link, you're getting 25 million sats, you're getting a quarter of a Bitcoin.
Oh, wow. That's high.
Back in the early days. So if you sign up 100 people, you get 25 Bitcoin.
Which, if you think about, like, from a counterparty, eventually people wake up and they're like, wait, why do I hold sailors? Like, why do I hold 5 billion with a firm that doesn't even hold any of this? Like, that doesn't even seem like consistent. Jackson, what was the quote from the RIA yesterday that he gave about the pain point? He's like, how can I custody at Coinbase if they can't even ensure the total balance of the Bitcoin that they hold?
I mean, there's a palpable concern as well, just the fact that it's one entity who custodies 90% of the Bitcoin ETF assets. And yeah, Michael, to your point, the sophisticated financial planner in the Philadelphia area just has been trying to figure out. He's kind of got the thesis wrapped together, or has formulated the thesis and understood it around the Bitcoin investment, but still trying to figure out how do you allocate to this thing, right? Because he has high net worth, ultra high net worth clients, and he doesn't feel comfortable from a fiduciary standpoint for them to hold devices and backup seed phrases to do self-custody. But then also he looks at the counterparties that are out there, such as Coinbase, and really can't get comfortable with trusting those individual institutions to manage the Bitcoin or custody the Bitcoin for his clients as well. So to me, it's still kind of shocking that Coinbase is the custodian for 8 or 9 ETFs, 90% of the assets. But then on the other side of their business, to your point, Marty, is just, trading revenue from shit coins like Pepe and Dog with Hat. It just like, I don't know how institutional investors kind of balance those two things.
But you don't hold any Pepe?
I've got a big bag.
Well, I went to dinner with Andrew Huns last night, and we were at dinner with somebody else who's had experience allocating money, large swaths of money for institutions, and that was a big conversation, and it became very clear we're deep into discussion about like why haven't the institutions got it, and so many of them got burned by Celsius, FTX, BlockFi. What was the one in Canada?
Quadriga,
FTX. They're all throwing the baby out with the bathwater. And that was like a big point of our conversation last night. It is going to be shame on Coinbase, because obviously they've not collapsed like the companies I just mentioned, but they're incentivizing the same sort of misallocation of capital at the retail level and confusing a bunch of institutional capital and not providing what I would deem to be necessary services for people that want to hold Bitcoin, which is the most important asset, not only in the space, but it's the only important asset in this space, in my opinion. But what's going to happen is people already burnt the career risk card at the institutional level. Many people did who allocated to these crypto funds and aped into FDX and Celsius and all these companies last cycle. And that's going to be the really sad thing to watch play out for the institutions that did burn that. The managers within the institutions who burnt the career risk card last cycle is, I think, as we discussed at the beginning of this episode, it's becoming abundantly clear that the time is very nigh to get into Bitcoin. And there are a number of institutions out there who got burnt last cycle that think Bitcoin is crypto and are not going to participate this cycle. And they're going to eat the career risk on both ends, where they burn it by going into all this crypto grift, and they're going to burn it on the back end by missing out on Bitcoin's price appreciation over the next few years. And it's just really sad to see.
Yeah.
I will say, though, go ahead.
Go ahead,
Jesse.
Beckham. Go ahead.
I was just going to say that there's a lot of sophisticated people paying attention. Was up in New York a couple weeks ago for the Bitcoin Investor Day event, and 700 people or so that showed up for this one-day event that was hosted by Pomp. And, the big names are there to speak, from Fidelity Digital Assets, BlackRock, Skybridge. And to me, it was pretty clear that serious people, sophisticated investors on the institutional side, managed wealth, ultra high net worth individuals, are really starting to pay attention. One thing in particular that stuck out to me was Anthony Scaramucci's presentation. It was one of the few that I actually caught during the day, but the one thing that he pointed out that is maybe obvious to the three of us, but still not obvious to Wall Street or Main Street when it comes to owning Bitcoin, is just pretend like you're dead with Bitcoin. Like, avoid the yield, avoid the active management and elaborate strategies that exist out there to trade Bitcoin and other cryptocurrencies, and just buy Bitcoin and act like you're dead. It's really that simple, right? The people who've performed the best with the asset are those who have done absolutely nothing with it. And it's so counterintuitive to the Wall Street culture, where it's all about generating alpha. How do you outperform a benchmark? What's your edge in a particular market, geography, region? How do you maximize Sharpe ratio? And it's not intuitive that you could own a better form of money that even on a risk adjusted basis, to use a Wall Street metric with the Sharpe ratio, it outperforms all of these active strategies. So I think that's all to say that it was impressive for, a first year of an event. There was about 700 people or so in a room. I think they oversold the event, and it was largely traditional finance folks who were there, and they're really starting to pay attention. I think of, the digital gold rush, and thinking back to the 1800s in California. And it's interesting, you guys may know this, but gold, I think, was first discovered there in January of 1848. But there was so much skepticism around the discovery of gold that it really wasn't until December of that same year, in, I believe, 1848, that President Polk shared in his State of the Union address a report from I think, Colonel Mason about the gold discoveries in California. And it was at that point that there was widespread belief of the discovery of this precious metal in California, and people from all over the U.S. and internationally traveled there for what became the gold rush. So I think the ETFs are kind of like the President Polk moment of Bitcoin. And it's starting to be really clear. And that event in New York 2 weeks ago was just one indication of that.
Completely agree. But
Awesome.
I want to make it clear to the listeners out there, Scaramucci, like, you have to watch out for this archetype of people talking about Bitcoin, because they can talk the game. They can say, just pretend like you're dead. Look at the Sharpe ratio. Look at this. But then they're going to try and sneak all the shit behind it, because they don't really care about Bitcoin, the revolutionary aspect of it, the fact that we have this non-sovereign money in the digital age. I don't think he's in it for the revolution. I think he's in it for the gains that he can see. And like, Scaramucci, play the clip, Logan. He's going to say all, like, this is an archetype, and I don't want to pick on Anthony Scaramucci specifically, but he deserves it. And there's many people like him who can talk the Bitcoin thesis and explain it very well, but then they're going to try and shovel shit to you on the back end.
Almost feel like you've got one foot in the coffin and the other one on a banana peel.
How are you going to compete with the big boys?
This season on the all-new Killer Whales, these crypto entrepreneurs from far and wide
pitch to me in 60 seconds or less.
come to pitch their projects to some of the industry's biggest names in hopes they'll pitch the next big crypto project.
You gotta relax, man. Roll the shoulders, loosen up. There it is, we're there.
Walk me through exactly how it works.
If the whales take the bait, they'll give the project a swim vote.
Even a child can create these worlds. So it's a swim for me.
Whoa! Congratulations.
But if their project fails to whet their appetite, they'll sink it to the bottom.
I just think the project is really bad.
You just love being the villain, don't you?
Kind of creep me out, so for me it's a sink.
Watch to see who will swim to victory.
It's not a crypto business.
I'm your only hope right now.
And who will be deep sixed to the seabed floor.
I see lots of potential in you.
Frank, I'm going to disagree with Croesus.
If we fail, the world is fucked.
I think it's time to sink or swim.
This is Killer Whales.
It's 2 yeses, 2 no's, and the vote is down to Wendy, who didn't understand us.
Pre-order now at Hello.
It's a game to these people.
Yeah. Logan, can you keep us on this screen? Because I think this is actually will be an awesome way to like wrap or just a conversation. Because there's a lot of things that I haven't said that are all like coming together based on what you just described, and I think there'll be a lot of feedback and interesting things. The first one is Jesse referenced earlier about boomers and individuals, and I think it's less about age, and I think it's more about a mindset. I think there's something like very just wired in individuals that see what we're talking about and allocating. And I think that goes all the way down to reputation in the short term versus long term. And so Marty is right in the sense of it's just anybody being careful for what people say and then what they do. Because like, I don't know, Scaramucci and a lot of folks that are now coming up the curve maybe are grokking it's Bitcoin, and that's how they store their value. And that's what they position in the ETF because that's the most kind of forward public thing right now. But the reality is the incentives in the system we exist in, you cannot raise capital on that story. You cannot raise that. This is partially why you see people support the long tail of crypto assets. The beauty of that is that they're actually kneecapping themselves and they don't even know it, because every cycle, every year, if you go and put people in the bad products, the truth always comes out. The cycle always, kind of flattens and people are left holding a bag of crap. And people don't forget, and their reputations are aligned. And when we go to rooms with these individuals and other individuals like that, they'll tell us behind the scenes, man, that was really smart doing Bitcoin only. And this doesn't even have to be about ideological reasons, or it doesn't even have to be about anything related to the efficacy or value of other cryptocurrencies. Anybody you ask or talk to is 80 to 90 to 100% weighted in BTC, whether it's the custody, the trading revenue, or just their exposure. But they're forced to show all this stuff because they can't go and raise money. And that's the beauty of Bitcoin. When you store your value in it, when you save in it, when you have people aligned with it, you can build companies like Onramp, and you can actually produce the value from a long-term sustainable business. And so everybody can go do whatever they want. Everybody will play the game that they want. But the long-term game, we know directionally, we've seen this for the past 5 years being in this space, is this game, because it's the one that's going to outlast everybody. So anyway, it was just like a tight bow of like all these different things that are happening. And we look at it and we're like, oh, I guess the last point is going into a room with a sophisticated investor. If you give them a buffet of cryptocurrencies, you're basically telling them like, nothing except for put 1% to 2%, because that's all they're ever going to do. Versus if you can be very singular and expose the asset from a multidisciplinary aspect, how we do with research, content, education, and in the conversations we have. Now somebody can start off the bat 3, 5, whatever percent, and they can actually look at this as a different form of savings versus a casino chip. And that's where the custody comes in. So that's the point to tie it, is that like everybody thinks, oh, so you offer more things, you get more market share, more trading revenue. The reality is they're going for 1% to 3% of somebody's allocation. Reality, we all on this call and most people that join are sitting on 30, 50, 90% because we understand the trade-offs, and that is the last trade. And that's the ultimate game. And none of these people can play that because they literally have to sell a buffet of 10,000 cryptocurrencies. So they hurt themselves, even though they believe that they're doing the right thing. And that's just the fiat mind.
Yeah, and they can hurt investors who fall for their scams.
Oh, yeah.
Don't buy their bags.
That's where we say, I mean, that's the point of like shilling this. And we've been in these rooms with the firms that are out there. We've been in the rooms with the large ETFs that are shilling 40 billion, 50 billion consulting firms. And they'll call us in to say, like, let's talk about Bitcoin versus crypto and explain it. And we leave and they're like, oh, wait, what have we been doing looking at this cryptocurrency thing? Like, if you ever get them, and we can have them join. We'll have anybody join a pod and discuss. They probably wouldn't want to, but it's always open for anybody to discuss, because it's pretty binary in the results of Bitcoin versus any other asset, whether it's a bucket or a singular asset, other than maybe like Pepe or whatever local racial slur coin that's out in the past 30 days.
Yeah. No, and it's, I think it's imperative that in Jackson, it was in no way trying to stomp on what Scaramucci said was right, but I think these people in crypto have done the Bitcoin industry dirty. Like, we have to go and literally rewire people's brains and be like, no, Bitcoin is not this. It is completely different. I know you got washed out with the tide last cycle because you allocated to all these crypto projects and these companies that were highly leveraged on this crypto thesis that is not materializing. But Bitcoin is different, and it does the Bitcoin industry a disservice to a degree. And I do think it is imperative to like stand up and say, like, draw a line, a demarcation. Like, there's Bitcoin and then there's crypto, and you have to separate the two if you are a competent institutional investor.
Yeah, that's right. I think it all comes back to, like, I think we forget how few people understand Bitcoin and what Bitcoin is. And the vast majority of people who are in crypto or excited about crypto or think it's the future are still in the fiat mindset. They're playing the fiat game. They're trying to find the next venture capital pump and dump to make dollars. They're trying to ride the next wave to make dollars, to buy low, sell high. It's venture capital on a faster timeline. It's penny stocks on a faster timeline. And so it's no surprise that you do have a lot of these characters who, belong in those worlds, stepping into crypto and seeing it as like a new frontier for their business model of how do you buy low, sell high. And unfortunately, they're the noisiest people, and the people that the culture, mainstream culture, believes, because mainstream culture is fiat. And so we sound like the crazy radicals when we're saying, no, just buy this digital scarcity and act like you're dead and just hold it, and your purchasing power will appreciate over time. Like that sounds crazy, versus ride the next wave, buy low, sell high, because that is part of, how the world works today, and people understand that. And so, for me, it's all about, when we hear Scaramucci talk about things, he's right about some things, but he's coming from a world that is antithetical to Bitcoin. And he's trying to bring those games too. He's trying to play both games. He's trying to make as much money as he can. And that includes stuff that is counter to how Bitcoin should be engaged with, which is, just focus on that, hold it, keep it safe, forget about the crypto noise out there. But, if you're a Wall Street person who's made a fortune by buying low and selling high, crypto is kind of irresistible. And unfortunately, everyone has to go through that learning process of thinking that crypto is part of the future, and eventually getting burned, or going deep enough down the rabbit hole to realize that it's not a part of the future, and then focusing on Bitcoin, because that is, where this is all headed. So it's a learning process. And I guess the positive spin on it is, if you understand that it's all about Bitcoin, you're way ahead of everyone who's talking about crypto. and that's a blessing. That's an edge. That's your opportunity for securing your Bitcoin wealth way before the rest of the world has arrived to California in 1949 and is trying to scramble to stake a claim. You're in California in 1948. Congratulations. Or 1848 and 1849. Sorry, guys.
Marty, the counter, like not counter, but to the point of not picking on anybody, but the dinner last night and that person, or the archetype that went into Celsius and these other firms, it's like, honestly, don't blame Celsius. They did their own, misdeeds or whatever. That was always going to be the archetype of a person that was going to go out on the risk curve. And they didn't do their diligence. And like, cause we work with the other side of that, where the person's like actually from a first principles thinking about the whole digital asset space, and they're building up from understanding gold and then thinking about what's the counterparty risk associated now that they're at Bitcoin. And so I just think that there's a natural lens of who got washed out is a very small micro example of the rest of people that have been sitting prudently, like as a fiduciary, looking at the whole ecosystem, waiting to jump in and make their move. I think obviously there's a lot larger position there that will come in this next cycle, and hopefully they learn from the previous. But I do hear you that like people have been kind of burned. Yeah, people have been burned, but I think like there's also those people got burned were because those were like fiat thinking people that like were like, oh, crypto, and they weren't like naturally, it's like they didn't think through it, because all you had to do was like do a little research and you'd be like, maybe this thing doesn't make any sense.
Yeah, you got to take it back to basics. The trap that so many of these people fall into is being too smart by a half, as Greg Foss likes to say. It's overthinking it, trying to be the smartest people in the room. And I think the perfect example of this is the cash and carry trades that pop up all over crypto. There's all these opportunities to short something and collect the premiums for futures funding rates if people are offsides disproportionately long. If you short it, you get to collect the funding rates and then hedge that out by going long. So, from a position standpoint, you are neutral, but you get to collect the yield from funding rates. That's just one example of cash and carry trade. There's lots of opportunities like that that amount to some sort of hedging scenario where you get to collect some nominal yield in the middle. And the thing is that Wall Street has developed in a way that they think that's the play. That's the smart move, is to just have the risk neutral allocation of capital where you get to collect the risk-free yield. And so that's what people get excited about. And that's how you get burned in BlockFi or Celsius, because you don't understand the hidden risks there, the actual counterparty risks of what if the counterparty that I have half of this trade with goes under, and then suddenly I'm shit out of luck for half of my deployed capital. That's how you get burned in that. And the assumption, the mistake that so many people made is assuming that these counterparties are as robust and safe and tried and true as people are used to in Wall Street, with the behemoths that have been operating for 100 years. It's just not the case in this market. So, that's that's the trap that fiat thinking gets you in, is how do I get the risk-free yield by finding some inefficient frontier in crypto markets and exploiting it. And that's where most people are going to start, especially the Wall Street types. That they start by trying to find some clever way to get their money without any risk, not realizing that they're actually taking on a great deal of risk and actually missing the much bigger opportunity cost of just parking your value in Bitcoin and riding the 30 to 50% CAGR every year, and outperforming everything in the market in the process.
Counterparty risk matters much more just because you can't print more Bitcoin. So we have that chart, right, that in our presentation materials where it's $120 billion of Bitcoin and crypto lost from either just losing it yourself or having exposure to the wrong counterparty, whether they stole it outright, it was hacked, or it was just poor management, which led to insolvency and you losing your crypto. I think that figure now is closer to 300 billion because that was originally produced in the depths of the bear market. So it is, people really have to think about counterparty risk, which in the Wall Street, with 2008 as an exception, people are not used to thinking about that in traditional finance. Like no one really cares to think about where are my equities or fixed incomes.
2008 just removed they're working under the assumption that counterparty risk doesn't exist because you always have that lender of last resort that'll step in. Like you will get bailed out.
The crazy part about that is that was 16 years ago. 2022 and everybody blowing up was literally 16 months ago, and nobody talks about nothing has changed in the market structure. Like not one thing.
Yeah.
We saw everybody blow up, everybody showed their hand, and nothing changed other than like maybe some patsies went to pretend jail or whatever.
Yeah.
Like that's the crazy part. And what does that look like, next year? And when what is it, 2x leverage ETF just came out this past week?
Yeah, be aware. Just be aware. This is a big be aware segment of the show. Stuff exists out there. Yeah, be aware. It's out there, gentlemen. This is a pleasure. I have to run.
Yep.
I'm sure we all do.
Are we? Is it homework for next week or not? Because it's a 45-minute thing. That's some real homework. I got to send it to Leon Wonkum, who's going to join us.
I think you should all read it. We don't have to discuss it. You can read it and determine if we should discuss it next week. I'm happy to, but very illuminating piece.
Okay, I'm gonna check it out.
Good history lesson at the very least.
Jackson, thanks for bringing the gold rush history in too. It's an important lens that it's very helpful for thinking about our current place with Bitcoin and the historical precedent. Like it's the fucking gold rush, and act like it.
That's a great place to end. Just act like it, right?
All right. Thanks, guys.
Right. See you guys.
See you, gentlemen.